Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries. As we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media, this is the show that connects the dots of confusion, delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. These mics sound a little hot this morning. Holy cow, guys. Let's a little less of me and, well, maybe not less of me. Well, everybody wishes there was less of me, but in any event, before we get into our intriguing content today, please join me in welcoming our featured guests and repeat offenders, both of them. Lisa Dunn is with us, Casabella Realty. Welcome.
Well, hello there, Ron. Nice to see you today.
Yeah, you're the first person that's ever said that.
It's nice to see you.
Exactly.
Can I take that back? I'm sorry.
Yeah. And Fadel Lawandy from Chapman University, welcome.
Good to be here, Ron.
Glad to have you with us as well. And let me remind you, if you ever have any home or finance related questions, I am the consumer advocate looking out for you, and you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are no operators standing by. I am it.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan or plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we are celebrating today. Always something to celebrate on Ron Siegel Radio. It is... you gotta find that whole list of things here, because sometimes there's some things we don't want to overlook anything. I mean, I try and keep up on top of all of the news of the day. Sometimes it's not even good stuff, but Chucky the Notorious Killer Doll Day. I don't know about that one. Saurus Day. Some people say it has to do with my disposition. It is what it is. Where's that from, Mitchell?
It is what it is.
And National Greasy Food Day. Having beaten anorexia, I will go with National Greasy Food Day. Never found a French fry I didn't like.
Does bacon qualify as greasy food?
No, that's just health food.
Oh, okay. I'm sorry.
See,
I got all excited there for a minute.
I go through all of the issues here. So we've got bacon is our meat group. Vodka gives us a little bit of fruits and vegetables. Wine gives us definitely some of the fruits. Dairy, I don't know if we even need.
Gotta have some cheese.
Okay, we'll go with cheese.
Wine.
We'll do. Well, it depends on how you're spelling the wine then. I just gotta throw that one in there. Checking the markets. Welcome to the roller coaster called the Dow Jones Industrial Average, down 131 points today. It was up a bunch yesterday. Amazing. Oil down 49 cents a barrel, and the U.S. 10-year Treasury has a breakout from that number. We're at 2.438. Now, we'll have to keep watching that one, because that means that mortgage rates are going up as well, because mortgage-backed securities somewhat follow the 10-year Treasury, although at some point in time, we will recover some of that 3/4 of a point to 1 full percentage point that's in that mortgage-backed security. That's just called regulation. I've told you this before. I've talked to many owners of mortgage banks, and many of them tell me that they've got between 3/4% and 1 full percentage point in the interest rate, just having to do with Dodd-Frank, where they're hiring more lawyers than loan officers.
Nothing like a little air superiority.
Yeah, that one there does not sound like fun. Now, I did watch a little bit here, and did you see yesterday that they started rolling back some of these issues? A little bit of the Dodd-Frank regulation. I saw that one go yesterday, where no more class or no class action lawsuits against banks. That was a tiebreaker that Vice President Pence cast, the tie-breaking vote, to nullify the rule allowing consumers to sue banks and credit card companies. Now think about this one a little bit. I looked at that and I said, okay, what's the motivation here? And who benefits when the banks and credit card, when you can sue a bank and a credit card company as opposed to going to arbitration? Well, the only one that really benefits there, and it's probably why we had to have a tie-breaking vote, who wins in every single class action lawsuit? There is only one winner in the class action lawsuits, and you can tell that I do not have a legal background here at all, but it's the lawyers. Ever notice, I got a check, I saw my son got a check the other day for a class action lawsuit that he was part of. He was on the winning group, in the winning class I think they call it, and his whopping check was 17 cents. Do you know how much money it costs to send out 17-cent checks? Now I believe that the postage is probably somewhere around 49 cents, give or take a little bit. Maybe they got a bulk rate pricing. The lawyers, they probably made millions or tens of millions of dollars. So maybe this isn't altogether bad where you can actually go to arbitration and maybe the parties will actually see some benefit to it. Just a thought there. Every once in a while there is a benefit there. Not being a Dodger fan, I have been harassed unmercilessly.
And it will continue.
Until tonight, about 8 o'clock, when the Dodgers have their first loss at home.
Ooh, take that back, Ronald.
Just saying.
Oh.
Yeah, well, last night Kershaw got his opportunity. Tonight Verlander gets his opportunity. And we might see what happens from there. You don't have a real series. I've said this many times in almost every one of the professional sports. There is no real series until the home team loses the first time. That's just the way it is. I'm just sharing that information. I also go and I look and see what's going on in other news of the day. You gotta love some of these things. The news that the Main Street media will not talk about. How about, what is it, about $5 trillion added to net worth around the world in the stock market run-up? Now, I'm not saying whether it's good or bad. I'm not saying whether it'll continue or not. But we are seeing that happen. The news isn't covering that. And the Russian collusion case. I wonder how far the news is going to go now that we know who paid for the infamous dossier. Yeah, the Main Street media, did you hear that one on the news? I don't know if you saw that one, but Hillary Clinton's campaign and the Democrat National Committee paid for this opposition research, and many of it's proving to be false research. Pretty interesting going right there, and obviously there are some quitters in the Republican Party now. It's interesting how there was a love fest when they want something. It's kind of the way politicians work, and I'm glad that I am not a politician, beyond having way too much baggage to get into that arena. I couldn't handle this stuff. The Corker and Trump going at it. You've got Jeff Flake, the Flake, going at it. He decides that after he's down by 25 points in a primary race, now an incumbent down by 25 points in a primary race, I think I'm going to retire. Well, that's called retiring before you get fired. That's basically the way it is. See the writing on the wall. So what's he going to do? Of course, what do you do as a Republican or as a politician? You go and you blame somebody else. Maybe, you know something, I'm just wondering, maybe Jeff Flake and Bob Corker can get on stage with Hillary Clinton. They could all join in the same complaints and the same blame game. All of them, they're right there. Amazing. Democrats in the news, more of them. Nancy Pelosi, Chuck Schumer, they are against, well, basically anything that the president says. It doesn't matter. They don't look at the facts of the matter. Think about this concept. They're against tax cuts. Now, the idea here is they're a group of people. Now, Nancy Pelosi never saw a spending bill that she didn't like. Yet all of a sudden, she wants to know who's going to pay for the tax cuts. Is that a little bit odd there? Just a thought right there. I can't believe that one. And I saw yesterday morning, we did a broadcast. I had an event yesterday, speaking engagement. Couldn't be here for a live broadcast, but I did want to get into this one. Another California elitist wasting their money, but that's good. Tom Steyer has plenty of money to waste. Maybe he could spend a little bit of his money. You know, I wonder, Just a thought here. I don't want to put Fadel on the hot seat here, but I wonder if Tom Steyer went to the Chapman Law School, he might be able to learn a little bit about the Constitution of the United States and see that just because you don't like somebody's policies, that's not an impeachable offense. I think the Constitution really has the legitimate reasons for impeaching somebody, and it's not because you don't like their policies or that you don't like the way they speak or the fact that they can tweet more than you can. Just a thought there, but at least think of the bright side here. You know, there's always a bright side in everything. Steyer is spending $10 million on campaign ads against President Trump, showing his own stupidity, and probably next year he's going to want to spend even more money promoting Democrats. Do you think anybody's going to want to listen to him at that point? Just my personal opinion, one man's observation, and being that I have the microphone right now, I get to share it with all of you. That's just kind of the way it is in the morning.
We can hijack this show, you know.
Not a problem there at all. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. New real estate laws coming to town. We're going to talk about that. We will also chat about the #1 reason to list your real estate, your house today. Should you get another credit card? And I think I saw a question that came in here. Should I use my bonus to pay $15,000 in credit card debt? We'll talk about all that and more. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Connect with us, Facebook.com/Ron Siegel Radio. On Twitter @Ron Siegel. And if you miss any part of our broadcast, shame on you. But the replay is available, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey, and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
Did you know that banks and credit bureaus are rewarded financially if you have bad credit? And the worse your credit score is, the more money they can make off of you? How does that make you feel, knowing that banks are getting rich off of your hard-earned money? How does it make you feel, knowing that if a bank or a credit bureau makes a mistake on your credit report, they benefit from it and it hurts you? The Fair Credit Report Act of 1971 requires banks and credit bureaus to report only accurate information, and nearly 100% of all credit reports are inaccurate. If you're sick and tired of being broke and tired of being robbed by the banks, you owe it to yourself and to your family to call Rondi. Rondi is a FICO-certified credit professional and has helped thousands of people just like you get out of debt and establish great credit. Rondi's number is 855-608-1990. Again, that's 855-608-1990. Or visit creditsanitizer.com. Again, that website is creditsanitizer.com.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452.
Are you a veteran, police officer, firefighter, doctor, nurse, or teacher? If so, you qualify as one of Ron Siegel's VIP heroes, and we have rewards up to $5,000 or $10,000 when you buy, sell, or refinance a home with one of the Ron Siegel radio partners. As one of the heroes, real estate agents will rebate part of their commission. Lending partners will give a credit at closing. The title company has special published rates, and many other service providers have incentives too. All you need to do is call Ron Siegel Radio at 1-800-306-1990. That's 1-800-306-1990. Or visit VIPHeroProgram.com. Just think about what you will do with all the rebates and incentives from the partners of Ron Siegel Radio. Just call us at 800-306-1990 so we can show you our appreciation for your service.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. In the real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Text NEST, N-E-S-T, to 79564. Find your dream home before someone else does. NEST, N-E-S-T, 79564. Number one reason to list your house now. The National Association of Realtors released the results of their latest existing home sales report, which revealed that sales rose 0.7% month over month, but remained 1.5% lower than they were a year ago. Some may look at these numbers and think that now is not a good time to sell their house. But in fact, the opposite is true. The national slowdown in sales is directly tied to a lack of inventory available for the buyers who are out in the market looking for their dream homes. Inventory of these homes for sale has fallen year over year for the last 28 months, has had an upward impact on home prices. NAR's chief economist Lawrence Yun had this to say, and I quote, "Home sales in recent months remain at their lowest level of the year and are unable to break through despite considerable buyer interest in most parts of the country." Bottom line, if you are one of the many homeowners who's debating listing your house for sale this year, the time is now. Let's chat about it. I'll put you in touch with a great real estate professional, and we will have that conversation. Lisa Dunn is here. She's one of the great realtors that we love to chat with.
Realtor. We're going to teach you how to say this property.
Say what?
Realtor.
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 I don't even want to talk about what
Monica
you're touring.
Nash would be proud of me right now.
Who?
Monica Nash. We did a little PSA on how to properly pronounce that word.
Okay, so now
You've been schooled, Ron. Sorry about that.
I'm used to being schooled. I need all the help that I can possibly get. It's amazing. So, but speaking of help, let's chat a little bit about this. So, we're going to chat this morning. Fadel Lawandy is with us. He's in the house. He is the educator. Chapman University. Welcome, Fadel.
Thank you, Ron.
So, before the broadcast, we were chatting a little bit about the idea of, home prices. We're looking at the stock market keeps hitting all-time highs. We see real estate prices keep accelerating. The bond market is going crazy. How do all three keep doing that all together?
Too much money in the market.
Too much, so the money should be flowing out?
Well, just right now, you have a lot of money that is coming into the stock market, the real estate market, and the bond market, and because there's no other place to invest in the world. If you look at returns globally, they're not significant. So you have an influx of cash that is coming in the U.S. If you look at the kind of from the bottom of the dot-com bubble, so after burst, the market goes down. You look at the amount.
So the dot-com bubble, that would be right around 2000?
2000.
Okay.
So if you look at the amount of cash that came into the U.S. specifically for investing in securities in the U.S., we're about that same number adjusted for inflation. Adjusted for exchange rates. We're about the same number that we had leading into the bubble burst of the housing market. So if you go from the bottom of the dot-com crash to the top of the housing bubble,
okay,
the amount of cash that came in that period, we've already seen the same amount of cash come into the U.S. from the bottom of the housing crash all the way up to now. So what we're having is that we're having a significant amount of cash. And bear in mind, the 2 years prior to the housing bubble burst, we had over 3 trillion US equivalent of US dollars come into the US. So that was a huge influx of cash, and we're about right there for this cycle as well. So a significant amount of money coming in.
So are you thinking that we're going to be seeing another bubble, and in what sectors?
Well, I would say that, are we in a bubble? No, we're not.
Okay.
But is the market overvalued in stocks, bonds, and real estate? Yes, it is. It's just in the prior cycle, all the money was going into real estate and real estate related investments. This time around, the money's going into everything: stocks, bonds, real estate.
But isn't that basically then the definition of demand?
Well, that's the definition of demand if it was justifiable, right?
Okay.
So you have an.
But who determines justifiable? I mean, if all of us have this money and we want to put it somewhere, right? That means we're demanding something, and some people are saying, "I demand real estate." Some say, "I demand corporations." Some say, "I demand bonds."
But the prices sometimes go too far. That's why we end up with bubbles, right? So the assumption is that the market is acting rational, right? Something's undervalued, we want to buy it because it appreciates in value. But the reality is that often the market or the investors in the market act irrationally, and they act irrationally for prolonged periods of time. Case in point, the housing bubble. Case in point, the dot-com bubble. That's when the market or investors kind of continue to act irrationally beyond the appropriateness of just simply a price driven by supply and demand, or value driven by supply and demand. And that's what we have here, because the $1 million question or the $1 billion question is that, okay, well, if all that cash came in and it's driving the market, and the Fed has been pretty much floating the bond market, the treasuries market.
Sure.
Now they're going to stop, right? They said that they're going to rebalance their balance sheet.
Sure.
They're going to stop buying more treasuries. They're going to stop buying more mortgage-backed securities. So while central banks have been floating the markets, causing that overvaluation, now that they're stopping, you're going to see the impact of that in the marketplace.
But they've been saying that for a bit of time now. I mean, everybody that.
Well, it hasn't been a bit of time. They just announced the normalization of the balance sheet. Just recently, the ECB out of Europe announced that they were going to stop buying 300 billion. I'm sorry, the quantitative easing of 300 billion euros a month. They're already announced that they're stopping that. So all of that is or should be reflected in the market, and we're not seeing that reflected in the market.
Well, there's a lot of things, though, that we don't see reflected in the market, and I think some of that has to do with the exuberance that you're talking about. I've been sharing on radio, on our broadcast many times recently, that historically, if we would have seen the rhetoric that was going between the President of the United States and the leader of North Korea, that would have a negative impact on the stock market, and money would flow into the safer area of bonds. But we haven't seen that.
Yeah, because the rhetoric aside, both sides know that they can't actually act on the rhetoric.
Okay.
So, and that's the reality of it. I think the White House understands, and all the people around the president understand, that a military solution is not the answer. But
in the past, though, that's been the same scenario where it's really a military solution is not the right answer, but just the rhetoric itself. I mean, we saw in the times with Iran and Iraq, just the thought of war.
Well, we saw the corrections in the market when that happened. We saw the drop in the market when that happened. If you go back to these comments coming out and what happens in the market corrects for it, but then it goes back on. It's
like a Teflon market right now.
Pretty much. It just everybody's excited about the potential for tax breaks, and every time that they come out and there's news that they're getting closer to a tax reform package, you're seeing that the market kind of rewards it. But how many times does the market reward the same thing? It seems
that seems to be a good question.
Over and over.
That is total logic right there. That the market can't reward it over and over. But, we have not seen anything as far as in the way of tax reform, and we haven't seen anything in the way of health care reform. Yet, just from the conversation of it, the earnings are going up. Consumer confidence, just based on the purchasing, and we see the durable goods orders coming out, significant. So what's driving those things? When there's, it's just kind of the facade, so to speak.
Well, the earnings are getting better. And we're seeing that there's quite a bit of improvement in the results that are coming out, partly because the dollar is a little bit cheaper than it was a few years ago. So what happens is a dollar cheaper. Most of these corporations are selling globally, so they haven't really increased their revenues, just their earnings number have gone up because the exchange rate has gone down.
Okay.
So there's an adjustment for that has to be taken into account. But even if earnings are growing, we've rewarded earnings in November, we've rewarded earnings in December, we've rewarded earnings even when we had not so good of earnings in the beginning of this year, the market still continued to reward it. So the question is, if you anticipate that the economy is going to grow at 2.2 real GDP, why are you anticipating that earnings are going to jump by double digits? Especially when the global market is not recovering as fast, and we're not seeing any signs of a reasonably healthy recovery as we've seen in the past.
Well, one of the big questions that we're going to have to get into then is, if we're looking at real estate being overvalued, the bond market being overvalued, the stock market being overvalued, and we know these things correct at some point in time. When they correct, people are going to end up...
Hopefully they don't correct all at once.
That was my question.
Yeah, I was going to ask, which one do you think is going to go first?
Right. And where are people going to put the money? So we're going to talk about that when we come back. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. More with Fadel, Lawandy, and Lisa Dunn when we come back. We're going to also talk about, should you get another credit card? Ask yourself these 5 questions. And we'll also talk about a $25,000 bonus, and should you pay off your debts with that or invested in the stock market? It sounds like we might have an answer right there. We'll talk more about that. You can reach me anytime off air, number 800-306-1990, 800-306-1990, or ronsiegelradio.com. Connect with us. Facebook.com/Ron Siegel Radio, on Twitter @Ron Siegel. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Stay tuned. We'll be back in just a few.
Siegel Lending Team offers you buying power. Let's say you can afford a monthly mortgage payment, including principal and interest, of around $1,900. With today's rate on a 30-year fixed mortgage of 3.75%, APR 3.85%, that payment could support a $416,000 mortgage. But if you wait and rates tick up to around 6.5%, which is roughly the average home mortgage rate over the past 30 years, that same $1,900 mortgage payment, including principal and interest, may only be able to support a $314,000 mortgage. That's over $100,000 worth of home you're missing out on by waiting. That's buying power. All you need to do to get started is reach out to the Siegel Lending Team at 800-306-1990. That's 800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Payment example excludes taxes and insurance. Call us for full details, 800-306-1990. That's 800-306-1990 or SiegelLendingTeam.com. Equal housing lender, licensed under NMLS number 217037.
Are you purchasing or own a luxury home? If you're like so many others, your home is your largest asset and the mortgage is your largest debt. The Siegel Lending Team has some amazing financing opportunities right now. Jumbo loans up to $2 million, 30-year rates below 4%, 15-year rates near 3.5%, and if you can believe it, 7-year interest-only hybrids in low 3s. The Siegel Lending Team has all the options for your jumbo or second home loan requirements. Take advantage of them while you can. To learn more about all the other financing products available from the Siegel Lending Team, call 1-800-306-1990. That's 1-800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Again, call 1-800-306-1990. Rates subject to change without notice. Licensed by NMLS ID 217037 and 145502. Equal housing lender.
Homeowners that are 62 and older are about to find out a great way to live a better retirement. It's called a reverse mortgage, and SLT can help you learn more. Call the Siegel Lending Team at 800-306-1990 right now to receive your free booklet with no obligation. It answers questions like how a reverse mortgage works, how
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities.
And give you
You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio.
your retirement.
Holy cow, we got a little feedback here, guys.
She refuses to go away.
Yeah, exactly. Yeah, we're going to get back into it regardless, even if she doesn't want to listen to us. Say hello to a few people here. Marie, good to see you. Kristen, good to see you. Glad you are doing well. Monica.
I got my posse online. I love
Robin, good to see you there. Lisa's posse, so we won't even go through
Jeff Campbell, I got Monica, I got
Jeff. I don't know what I can't read that much, Jeff. So I'm just going to say okay. Joe, good to see you. Sorry about your Yankees. Sorry that they didn't do too well. Jim, glad you're on with us as well. Robin, good,
hi Robin.
Good to see the whole gang on here. So let's get back to it. Love this question. This one came in, and I don't even remember who it came in from, but I've got the note right here. Should I use my $25,000 bonus to pay a $15,000 credit card debt or invest in blue chips? Now you always love when I get questions like that. Should I use the money or invest? Now when you put $15,000 in debts onto your household, did you plan on ever paying that back? And what was your plan on paying that back? So the thought here is if you put it on a credit card, it was because you said, oh, I'm going to have that money a little bit later. And now you've got that money and you're saying, I'm going to spend it some other way. Does that make any sense at all? I'm going to say that that's not the best thing in the world right there.
A bad feeling about this.
So take your money, and then the other part of it is now we're chatting this morning with Fadel Lawandy, Chapman University, and we're talking about this concept that, the market, and I don't know, Fadel, maybe, I'm guessing that you don't have a big crystal ball because otherwise you wouldn't be teaching at Chapman. You'd be investing in the market if you knew exactly what the market's going to do, when it's going to do it, and by how much.
I do have a crystal ball. I just enjoy teaching it.
Oh, okay. There we go.
I graduated from there, so it's only logical that I spend my relaxing years there.
You graduated from Chapman?
Yes, in the 90s.
I won't hold that against you, and especially being that I did it in the 80s, but I never went to Chapman University. I graduated in 1984 from Chapman College before the university days. But here's the thought: is we're talking to Fadel and we're chatting about the markets being overvalued right now. So the question would be, when we look at this concept, $25,000 bonus and $15,000 in credit card debt, average interest rate on your credit card debt is probably 20%. What else are you going to do with that $15,000 that's going to get you a 20% rate of return? Pay the debt. Get out of debt. That is the Word on Wealth segment today, being brought to you by CreditSanitizer.com. Go on Credit Sanitizer because I know that your credit report is wrong. And the reason I know your credit report is wrong, they all are. I've never seen a credit report that is not wrong. So go get your credit repaired. Check it out, CreditSanitizer.com. Continuing our conversation this morning, Lisa Dunn is in the house and Fadel Lawandy is in the house. So we were talking before the break. We want to find out which of the markets are going to correct first. How much?
That crystal ball. We want to hear what your crystal ball has to say.
It's been a long time since we've seen any kind of a market correction.
Yeah, you actually don't need a real crystal ball. There's an app for it now.
There's an app.
Says Mr. Actually, not on social media.
My son has it.
I was going to say, you probably found that on your Facebook.
Is it like a magic 8 ball? You take your phone and just shake?
It is a magic 8 ball.
I got to get that. Oh, my.
Going back to your question, I think that we start seeing a little bit of correction, and we're starting to see it yesterday and today in the bond market. And hopefully it will continue to be kind of a very slow and meaningful adjustment and not just a bottom falling out.
Which is kind of what the Fed said that they were going to do with the rebalancing their balance sheet.
Yeah.
It's just instead of selling, they're just going to let the
maturities mature and the coupons not reinvested.
Right.
So that definitely will help relieve some of the pressure in the bond market, and hopefully that the international investors that have kind of ran to or fled to the U.S. Chasing returns, although we say interest rates are low here in the U.S., it's a lot lower outside the U.S. So those international investors will continue to stay on the market and kind of slowly transition out and repatriate those assets in a meaningful and organized way instead of kind of rushing.
So how do we How do we justify this, Fidel? Because I'm looking right now, I've got the screen in front of me. The U.S. 10-year Treasury is at 2.43 as we speak. The German 10-year is at 0.48, and they're usually about a point spread in those.
Because if any of these foreign bonds start picking up yield where their yield is meaningful and significant enough to motivate those international investors here to repatriate their funds so that they don't have the exchange rate exposure, then we see the bottom fall. So the fact that we're...
The bottom fall in yield or in price?
In price.
Okay.
Which means the yields will go up, but your bond is now worth 20 cents.
Right.
So the reality is that as you systematically see those yields very slowly internationally move up, then you'll start seeing that money kind of retreats. We see our yields slowly move up and it's a soft landing. But you see the yields internationally pick up fast, which doesn't appear like it's happening. That money gets repatriated much faster, and you see that the value of the treasuries drop significantly. You see the yields jump, and we go back to 1980s mortgage rates of double digits.
We don't want to see that.
No.
So now let me ask you this question then, because you usually look and you say, okay, well, the yields, the bonds are going to be an indication of the strength of the underlying asset, so to speak. So we got a 2.43 in the U.S. 10-year, and the only thing that's close to that are Italy and Spain.
Two places where you don't want to invest your money.
Right. So you wonder, how does that work? You had an economy that seems like it's probably a stable economy in Germany. You basically get nothing for your money.
Well, because it's a stable economy in Germany. They don't have to pay as high of an interest rate to attract money.
So why do we then?
Well, we need to get our yields up, because one of the ways that the Federal Reserve, because all indications seem to be that the U.S. economy is recovering, having prolonged periods of low interest rates as we have experienced in the past decade plus has adverse effects on the market, because you have a lot of cheap money around. So the increasing in interest rates kind of starts kind of stabilizing the marketplace. More importantly, if we hit a recession and our Fed rates are at the bottom, they have to go to negative interest rates like the rest of the world.
So they have no quivers left.
So they need to build...
Or arrows, I guess.
Yeah.
Arrows
in the quiver, something like that. It's a little early.
English is my second language, so I wouldn't know if you were saying it wrong.
We can get a whole lot past him then, right?
So the reality of the matter is they're rebuilding their toolbox. Thankfully, we're not, when you saw the Fed increase interest rates back in the fourth quarter of 2016, we saw the 2 rate hikes this year. We didn't really see a significant jump in the 10-year Treasury or the mortgage-backed securities, and the reason for that is there's still enough demand coming into the bond market and the mortgage-backed security market that is keeping the yields down, because the demand is pushing the prices up. So the reality is the Fed is able to push those rates up without seeing any significant impact on actual interest rates in the marketplace, and that's the optimal time to do it.
Does that tell us that the market is strong enough? Because 3 years ago, when the Fed would make a simple comment that we're going to raise interest rates, the market would go crazy. Right now, the Fed says they're going to increase interest rates and nobody cares. So does that really just tell us that it's really more that we're kind of at the right time, or are we just numb to not listening to what the Fed says because they've cried wolf so many times?
Well, I don't know about that we're not listening. We're listening, but you're taking all the factors. The marketplace is great because it takes all the information into account, and there is significant enough information aside from what just the Fed is doing to keep the markets motivated. Everything from potential tax reform to the relaxing of Dodd-Frank, as you alluded to earlier in the broadcast. There's a lot of moving parts, and there's more positives than negatives. The question is are we properly rewarding the positives and properly penalizing the negatives, or are we on the exaggeration side of the equation. The market gets very excited yesterday. As you mentioned, the Dow was up about 160 point on the potential for a tax package kind of making its way through the legislative bodies. But then this morning, the Dow was down about 130 point. That kind of volatility is a good indication that the market is really not really sure how to interpret the information, and that's where the challenge comes from.
Well, I have a quick question, just from boots on the ground, unless we're running out of time.
No, go ahead.
You know, for the past 4 years, we've been running around telling our clients, oh, you know, right now is a great time to buy. You know, interest rates are going to go up. At this time next year, the rates are going to be 5.5. I mean, for 4 years, we've been hearing that. What do you think is going to happen this time next year?
No,
don't tell me 5.5 because I'm not going to believe
it. That's the $1 million question.
Get out that app and shake that crystal ball.
We're going to talk about that when we come back. Interest rates, where are they going? And we're going to get into real estate when we come back as well. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. You can reach us anytime. Our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Connect with us, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, shame on you. Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few. Well, we are obviously having a little bit of technical difficulties on the radio side of what's going on, so we are going to kind of play around with this for 1 second here, then we'll be back and get things rolling once again. Give me just 1 second here to catch us up on that part of the broadcast. It should take just a second here. Aha, here we go. I think we should be back live with you on the radio side now as well. Welcome back to Ron Siegel Radio. Within every market there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. So every once in a while when we have some technical issues, one of the beauties of being a live, well, I guess the beauty and the challenge of live radio is changing on the fly. So right now all I'm going to do is tell you that the Mortgage Minute brought to you by Gold Star Mortgage. When you are ready for that next mortgage, Gold Star is the only one with the Fast Pass loan approval. Let your real estate professional check box J4, no loan contingencies. And in many, many markets, no loan contingencies means that you may not be paying, you might save about $10,000 to $50,000 when you go to buy a piece of property. Because the two things we know from real estate, the two biggest things we know, whenever there's a listing agent does check with has a listing on property, what do they look for first when they go to get an offer on a piece of property? The two things that listing agents always look at first, they want to know what is the price that the offer comes in at, and what are the contingencies of the offer. We know that just from history. So think about those two issues. When there is no loan contingency, a lot of consumers have a much, or sellers have a much better concept that they know their property is going to sell. So I'm going to skip the report this morning, just tell you the background of the Mortgage Minute, and get back to our conversation this morning. Fadel Lawandy, Chapman University, is with us. Lisa Dunn, Casabella Realty, is with us once again. So Lisa, before the break, you were posing this tremendous question to Fadel, putting him on the hot spot.
Love putting him on the hot spot.
Where are interest rates going?
30-year fix, 5% down, 5% interest rate in a year.
What about 20% down?
5% down and a 5% interest rate.
You heard it here first.
In 1 year.
30-year fix in 1 year.
You left off that 0.5 so I wouldn't smack you, right?
No, it's just simply that's kind of where the rates need to go. And pretty much looking at where the marketplace is right now and the fact that yields are starting kind of to correct upward, it's not out of the question to expect a 5% mortgage on a 5% down.
When do you think we're going to start seeing that upward trend?
It really will depend, but you could start seeing that as early as the first or second quarter of next year.
So here's the question, because and I'll really put you on the spot now, Fadel, because one of my favorite references when we chat about forecasting, and I always show my age when I talk about this, is one of my favorite references. Like I go back to whatever they had to say at the economic forecast at the Anderson School at Chapman University. Are they coming out with a 5% mortgage rate when they do their, was the forecast is the beginning of December?
They don't forecast mortgage rates. So they...
Oh, okay. Okay, so you're safe there.
They don't forecast mortgage rates.
Okay, so generally we see mortgage rates at about, historically they're about 0.5% to 1% above historically. I mean, they haven't been acting properly recently, but it's generally about 0.5% to 1% over the 10-year Treasury.
Yeah.
So if we're looking at a 5% next year on mortgage rates, that would be saying somewhere around 3.5% to 4% on the 10-year Treasury.
That's about right.
Now, I know that's where it should be, but what type of an effect will that have on the market if it has that big a jump that quickly? I mean, that's basically doubling what the yield is, because we were at what 1.83, 1.84 2 months ago, and if we go to 3.5% to 4% on the 10-year, That's a pretty massive jump short term.
Well, that's assuming that the demand for the mortgage-backed securities is going to continue to be where it is right now. And as I mentioned earlier, as rates start normalizing, as we start seeing what is projected to be possibly 2 rate hikes next year from the Fed.
Well, there's another news flash right there.
Well,
so you're projecting two rate hikes?
That's what pretty much all the minutes on the commentary seems to be hinting towards. So if you account for those two, and you account for where the treasuries are, you should be able to kind of justify a 5%. But the reality is, you're at like what? You're about 4.125 to 4.25 on the same loan today. So that's only.
Oh no, we're actually, well, as of last Thursday, we're 3.88 is the Freddie Mac
on a 5% down.
No, that's just the Freddie Mac 30-year.
Yeah,
right. That's not
on a 5%. On a 5% down, you're about 4.25 on a good day.
Yeah,
would possibly pay in a quarter point or so. So the 5% on the same loan by November of next year is not kind of out of the ordinary, especially when you look at the spread right now between the rate and the 10-year treasury is over 2%.
Sure.
So if you hold that 2% constant, you're just simply saying that the 10-year treasury is at about 3%.
Okay.
Question for you though again. So we were talking about the three overinflated, I guess you could say, markets. Do you think that's going to have an impact on housing?
I don't think it's overinflated. I think it's overpriced.
Overpriced.
Yeah.
What do you think on housing if the interest rates actually do get into the 5s or that magic 5.5 number?
It definitely has a slowdown effect on the transaction side of things as it relates to housing. The reality is that affordability has become a national issue. It's no longer an Orange County issue or a San Francisco issue. It's across the board.
So I'm looking at the affordability index right here, and you might even be able to help us to understand the index itself a little bit better. But I'm looking at 2012, the index was about, on this chart, 85 for Orange County. 2017, it shows as 65. So it's showing it's down 12% year over year, 7% month over month on affordability. Does that mean that it's less affordable or more affordable?
When compared to 2012?
2012.
Well, 2012, you could scoop up all kinds of things in 2012.
Because you look at some of the numbers, I'm even going back, even if you go back to 2008.
If I'm not mistaken, and I'm not sure which affordability index
you probably can get an affordability index from everybody. It's based on a 20% down payment, median home price. A reading of 100 means a household. So a reading of 100 here means that a household earning median income can afford the median home price with 20% down. So it's based, to me, the way I understand it is the higher the number, the less affordable, or the more affordable.
The more affordable. More affordable. It is, yeah.
So in 2008 or 2008, we were looking at about a 70, and now we're at about a 65, 66.
And it's a downward trend.
Right, absolutely downward trend.
Yeah. And we can't benchmark to prior to the prior years because yes, it was a lot less affordable back then, but you had exotic products that allowed people to get into homes that they shouldn't.
Exotic. That's a nice term.
Well, it means if you could fog a mirror.
Do you have a pulse?
You know what they called back in the days the Ninas, no income, no asset. Imagine lending somebody $500,000 or $600,000 or $700,000. And saying, yeah, it's okay. You don't have to tell me if you have money or where your money's coming from the down payment. You don't have to tell me how much you're making. Yeah, anybody could buy a home.
No income, no assets, no problem.
Ninas, the CISAs, income stated assets were the same thing. Neg-Am mortgages. They used to call them the freedom mortgages.
Right.
I'm dating myself, but
I haven't even heard that.
The reality is that world is completely different to today's, and the bigger challenge today is that back then you still could get into an apartment at a reasonable rent.
Right.
Today, you can't get into an apartment at a reasonable rent.
So I'm looking at the Orange County. The big question will be coming then. Orange County looking at 42-year history. 4.99% is the average appreciation. 9.77 last year is way too high, I think. 5 years with cumulative 23.06, too much. Are we going to continue with is that, does a 5% growth rate look like it, is that too big a number, or is that seem like
it's a big number, but I wouldn't be surprised if I continue to see it for another year or two.
Okay. And then we have to figure out what's going on.
Well, and then we're going to have to figure out the number of people that are living on the streets.
Yeah,
because that's where we're heading. Is because if you look at the demographics and Joel Calkin at Chapman and some of the other people that study this more carefully have appropriate numbers than I do, but according to last numbers that we saw at the Housing Summit just a few weeks ago, you get the people from 35 to 45 leaving Orange County, and where they're popping up in Texas. Those are the most productive part of our population. So the billion-dollar question is that, does Orange County continue to be relative, or does it turn into, what is it? Where's it in Florida where all the retirees go?
The whole state.
Yeah. There's been talk of that.
Or does it turn into Florida where it's the people that are retiring that have the money, that are able to pull the equity out of a home somewhere and be able to...
But we've got a quick question for you, because I've only got about 10 seconds left, is that probably 4 or 5 years ago at Chapman, they did a study based on the higher income earners, the amount of tax returns within the state of high income earners versus a lower income earner. Mm-hmm. Is Chapman still doing those kind of studies?
If they do, I'm not.
Okay.
They haven't told him about it.
So if they are doing that, then the idea is you'll probably have to go on Chapman's website and join us at the economic forecast, because that's when we'll really find out if they're doing that for sure, because they do share that information there. It is a great forecast, and they're generally spot on. Don't let Jim Doty hear me say that, or any of the other staff over there. But they are pretty accurate with that. So if you want great information, Chapman University's economic forecast, usually I think it's early part of December, isn't it?
Early December.
Early December. Great information. And be sure to set that first radio preset button to come back here every day to join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to John, who's engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. And again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. Talk to you next time on Ron Siegel Radio.